Alright, so today I wanted to make a quick video on all of the Canadian stocks that I currently own, and I will get into briefly what I think of them and how eager I would be to buy if they were at the right price. So the first one here is GoEasy. Now GoEasy I think is a solid example of a dividend growth stock. I mean, they're only a $3 billion company, and speaking of their dividend, it's only 2.5%, but the payout ratio is about 30%, and they've been growing that 20 to 30% per year over the long run. Now again, with a payout ratio of 30%, they're definitely going to be able to keep growing very quickly. Their revenue is still projected to grow quite well. I don't think they're going to grow as well as they have historically, but historically they've grown extremely well. And I mean, if you compare them to the S&P, over the last decade, they're up 1,100%, almost 1,200. The S&P is up about 200. And I mean, even if we go, let's say, 5 years out, they've still more than doubled the S&P. So this is a company that's always destroyed the S&P. Do I think that'll happen in the future? Probably, especially when you include dividends. But I don't think it'll be by as much. But I still think it's a very solid buy. Not necessarily where it's at right now. I think it's a little expensive where it's at right now. It's basically just a hair above its historical valuations. But the reason that I'm not super eager where it's at right now, the main reason is I bought this right near the lows of last year, which is around $90 a share. If we go back a year, it got down, this was actually a little bit over a year ago. So it was like right here. It got down to about 88. So I bought it at like 90 or 91. So this is one of the handful of times to where you will realistically actually time the market almost perfectly, because this is one of the stocks that I did that on. So again, I'm already well over, I think I'm probably 7 or 8% in the personal portfolio, so I don't think I'll be buying any more of this anytime soon, especially considering I'm reinvesting dividends. But if it got that cheap again, I probably would add a little bit, even though I'm arguably overexposed. The next one is EQ Bank. Again, this is another example of a dividend growth stock. Now again, they're a bank, so I don't think you're going to see crazy amounts of growth necessarily. But if you look at its historical valuation, it has outperformed the S&P 280% versus 227 over the last decade. If we go back 5 years, it's actually outperformed even more, 152 to 100. So again, another example of a company that's historically outperformed the market. Now again, you have to keep in mind that historical performance doesn't equate to future performance, but on average, if you have a company that all the metrics look good and it's historically outperformed the market, it's overwhelmingly likely it's going to do that in the future. Now again, just my opinion, but that's what I would say. Again, 2% dividend, but they're actually increasing that even faster. I mean, if you go back to the 10-year, it's 18% per year. 5-year, it's 23. 3-year, it's 34. And again, the payout ratio is only 14%. So this one, I mean, EQB probably will grow their dividend faster than GoEasy. And I mean, quite honestly, they might grow it as fast as any company on this list. So if you're looking for a good example of a dividend growth company, this might be one of the best examples. And they're still growing very well. I mean, and not only that, they trade at a fairly low valuation, which some people may consider a red flag, but I don't. I mean, their PE is just over 7, which is historically below their 5-year average. So this is definitely an example of a company where you could be buying it where it's at right now. I think that it's worth probably $100, $110 a share. If you compare it to TD, or just using an example here, they trade at a 12 PE, which makes no sense to me, because EQB is growing faster, and yet they're trading at a lower valuation. To me, it doesn't make a lot of sense. So I think that EQB's PE, in theory, should be probably around 12 or 13. So I think they're probably 10, 20% undervalued where they're at right now. Again, just my opinion, but I don't see any reason they shouldn't be worth more than a TD or a Royal Bank. If we look at Royal Bank here, let's just see what they trade at. I know they're higher as well. They're at 13, so they're actually even higher. So again, I think that EQB definitely a no-brainer in my opinion. The next one is ATD. This is Alimentation Couche-Tard. Another example of a dividend growth stock. This is another company that's absolutely demolished the S&P over the long run. If we go back a decade, again, it's 500% versus 227. The 5-year is actually, they're about even. They've only slightly outperformed the S&P. But again, a lot of that is due to a recent drop off. But again, another example here, payout ratio of about 16-17%, but they're growing it 25% per year, roughly, like clockwork. Like clockwork, they are growing that dividend very, very nicely. So if we look at its valuation, I think they're probably about fair valued. If I was guessing, they're actually slightly above their historical price to free cash flow and PE. But an 18 PE for a company that's outperforming the S&P 500 historically, I believe the S&P's 5-year PE probably is around 18 or 19. In my opinion, if anything, it's undervalued where it's at right now. I would set fair value probably $80 to $85 a share. It's currently at 78. So I think it's probably slightly undervalued, at least in my opinion. The next one is CN. This is more of a stability play right here, because this is a company that, number one, it is almost impossible. It would be almost impossible to compete with this company. I mean, obviously CP exists, but if there was a third company to start out of nowhere, it would be almost impossible to compete with these two companies. So number one, it is a great moat, and number two, it has great historical performance. It's not an amazingly good company, but I would say, but the stability, the moats, I think, are the main reasons that I own it. And again, another example of a solid dividend grower here. The payout ratio is definitely higher. It's 39 or 57 based on free cash flow, but they've been growing it between about 10-11% per year, which is, again, with the higher payout ratio, you're not going to be able to grow as well. This one has underperformed the S&P over the last decade, but not by as much. And also, if you look at it, it's done it in a less volatile manner, which I do like that. If we look at the last 5 years, it looks like it's actually outperformed by even more, by a lot. Am I concerned? Honestly, no. Although I think that if you look at its valuations here, it is still, I would say, probably about fair value where it's at right now, maybe even a tiny bit overvalued. But my cost basis on this one is probably like, I don't know, 130 roughly. So, I mean, I'm still up a decent amount. Again, if this one went below its historical valuations, I would probably buy. But this one probably about fair value, maybe a tiny bit overvalued where it's at right now, because I think the long-term growth is not necessarily going to be amazing. But this is one, you're kind of buying it for the stability and for the moat. So if we go to the next one here, the next one is BAM. This one, I own the American ticker here, just because in the future I might want to trade options or covered calls. But again, it's still a Canadian company. Again, this one, you notice a similar theme here, that there's really only one company, I think, that isn't a quote-unquote dividend growth stock, or you're not buying primarily because of dividend. Again, this one is a 4% yield currently, and they're growing it extremely fast again. So that is why I am buying them. This one's a dividend one. This one's more of a pure play dividend. I don't expect a lot of growth in the share price, but again, I do expect a nice juicy dividend. The next one is Constellation Software. I do have a very small position in this one. I'm kind of waiting for it to get cheaper to buy more, because I think it's overvalued where it's at right now. But this company, again, another very good company. It's just too expensive where it's at right now. I mean, a PE of 102, a price of free cash flow of 32. I think my fair value is like 3,400 roughly. Just off the top of my head, that's probably about 10 to 15% below where it's at right now. So I would wait until it gets down there before I would buy more, which I definitely would. but I don't know if that will happen anytime soon. We will have to wait and see. As far as other ones go, there is actually only one more, and that is CNQ. That's Canadian Natural Resources. Again, this is an oil and gas company. I think that this is probably the best Canadian oil and gas company. Honestly, I'm sure there's smaller ones that have a really high risk reward if that's what you're looking for. But as far as more of a pure play, if you could only own one, and that was all you were allowed to own for the next decade or two, this is the one that I would choose. Again, historically, it's done well. It has, again, free cash flow yield 9%, which is very nice. The dividend is about 4.5%, so they're growing that dividend 30% per year over the last 3 years. Even over the last 10 years, they've grown at 16%. This is one of the handful of oil and not a lot of oil and gas companies didn't cut their dividend back in 2020 or 2021. This is one of the handful that didn't, which I think is another example of a very good company. And I mean, just looking here, congrats if you bought it at those lows, because you would have a 29% yield on cost if you bought it at the lows. So that is just absolutely insane. Again, if you go back a decade, it's actually slightly underperformed the S&P. But if you go back, let's say 5 years, I'm going to guess that it's actually outperformed by quite a bit. Yes, it has. So I think that this company probably will outperform the S&P, but you're buying it primarily because of the dividend. Again, 4.5%. They're growing at 16% per year. Payout ratio is about 50%. I think they're going to be able to maintain that. I think that over the short run, we might see a recession or an economic downturn in the next year or two. But over the next decade or two, I don't see the demand for oil going down nearly as fast as people think. If anything, I think it'll go up. And in the meantime, that will provide tailwinds to companies like this. So anyway, that is what I wanted to bring up today. If you liked the video, please like, comment, subscribe, all that good stuff, and stay tuned for more.